So, what if you could just buy everything? Like a little piece of every single stock, every bond, every asset on the planet. It sounds kind of perfect, right? Well, today we're going to deconstruct that very idea, the ultimate global investment strategy. I mean, it seems like the ultimate safety net, the most diversified portfolio you could possibly imagine. But what if owning a piece of everything isn't actually the best strategy? What if it's got some serious fundamental flaws? That's the big, juicy question we're digging into in this explainer. All right, so the basis for our discussion today is this really fascinating paper from Goldman Sachs. It's called, and you've got to love the title, Investing in Everything, Everywhere, All at Once. The authors are Christian Mueller-Glissman, Andrea Ferrario, Alessandro Giulio, and Peter Oppenheimer. So let's jump in and see what they uncovered. And the abstract really just lays it all out for us. They start by defining this world portfolio, which is basically the sum of all investable assets. They say it's a useful benchmark, but, and this is a big but, it's rarely been the optimal way to invest. They point out how U.S. assets have been a huge driver recently, how performance just swings wildly depending on the economy, and this is the best part. They actually recommend strategies to improve on this benchmark, so they don't just leave us hanging. Okay, so what is this world portfolio really? Just think of it like this. It's the total market portfolio. It's the sum of every single publicly traded stock, bond, and alternative asset in the entire world, all weighted by how big they are. It's the theoretical gold standard, the benchmark everyone compares themselves to. And the scale of this thing is, well, it's just mind-boggling. We are talking about a portfolio worth an estimated $250 trillion. To put that in perspective, that's literally double the entire world's GDP. This isn't just some index. It is the financial mothership. Now, here's where it gets really interesting. Let's look at what's actually inside this thing. You can see right here, U.S. equities and U.S. bonds. Together, they make up almost half of the entire global portfolio. That huge concentration in the U.S. is a massive theme, and we're definitely going to circle back to it. So if this is the ultimate benchmark, you'd think it would be pretty solid, right? Well, the authors decided to put that to the test. They went back and analyzed over 70 years of data, and what they found were some pretty serious cracks in the foundation. And they were really rigorous about how they did this. Their methodology had two parts. First, they built a long-term proxy portfolio going all the way back to 1950. For that, they used monthly data from sources like DataStream to reconstruct a historical universe of global stocks, government bonds, and gold. But then, for a more modern view, they created a second investable index starting in 1990. This one used daily data from places like Bloomberg and Prescient, and it included a much broader set of assets, things like credit, real estate, private markets, and even crypto. So what did all this data crunching show? Well, for one thing, this portfolio is anything but static. It changes, and it changes dramatically depending on the era. Back in the golden age of the 50s and 60s, stocks were everything. Then came the 70s and stagflation, and suddenly gold was king. Remember the late 90s? The tech bubble pushed equities to a peak of 60% of the portfolio. And ever since the global financial crisis, it's been the story of U.S. stocks. This constant shifting, this historical volatility, it really shines a light on three core problems with the idea of just passively owning everything. Let's break them down. Okay, problem number one. This is absolutely not an all-weather strategy. Its performance is incredibly sensitive to what's happening in the broader economy, what the paper calls macro regimes. And this chart just says it all. In what you might call a Goldilocks economy, growth is good, inflation is low, the portfolio does great, it thrives. But just look at what happens during stagflation, that nasty mix of low growth and high inflation. Think the 1970s or that shock we all felt in 2022. Performance just falls off a cliff. Stocks and bonds go down together, which is exactly what you don't want. Next up, problem number two, that concentration risk we mentioned earlier. Right now, the portfolio is just so heavily skewed towards U.S. assets. And yeah, that's been fantastic recently, but it's a massive bet that one single country is going to keep outperforming everyone else. And the authors say it perfectly in the report, quote, "While U.S. asset dominance was a tailwind in recent years, regional performance has varied historically." What that really means is simple. Betting on yesterday's winner is no guarantee you'll win tomorrow. And that brings us to the third big problem. Because the portfolio is weighted by market value, by how big things are, it ends up dramatically underallocating to smaller assets that could be really powerful diversifiers. So it pretty much ignores or gives tiny weightings to things like private markets, crypto, and a whole range of alternative strategies. And here's the real kicker. By just owning the benchmark, you're missing out on a big opportunity. The paper actually ran the numbers and showed that a risk parity strategy, that's one that balances the portfolio based on risk instead of just size, and so it gives more weight to these smaller diversifiers. It delivered way better risk-adjusted returns since 1990. Okay, so we've established the world portfolio is flawed. The million-dollar question, or I guess the $250 trillion question, is how do we fix it? The good news is the paper doesn't just diagnose the problem, it actually gives us a strategic framework for how to make things better. And the core idea isn't to just throw the benchmark out the window. It's to actively and strategically tilt away from it. This means you're making deliberate, long-term adjustments based on a forward-looking view, not just looking in the rearview mirror at past performance. The author's model boils this whole thing down to 3 concrete steps. Step 1, manage the mix. You actively adjust your weights to stocks, bonds, and gold based on the economic regime. Step 2, manage your U.S. exposure. You make a strategic call on how much to allocate to the U.S. versus the rest of the world. And step 3, add diversifiers. You intentionally bring those smaller assets and alternatives back into the fold to improve your risk-reward profile. This timeline here really shows what that strategic tilting looks like when it comes to U.S. stocks. And the big takeaway is this. The optimal weight for U.S. stocks has almost never been the same as the benchmark weight. Look at the 1970s. The best move was to be underweight the U.S. Then, in the decades after the global financial crisis, the optimal tilt was way above the benchmark. And today, the paper's model suggests that gap has narrowed a lot, which means the clear advantage of being overweight U.S. assets, well, it's not nearly as obvious as it used to be. All right, so after all that deep analysis, what does this all mean for you, the investor? What's the bottom line from this incredible deep dive into the world portfolio? Well, it really boils down to this. The world portfolio is a super useful concept, but as an investment strategy, it's pretty flawed. If you just blindly follow a benchmark, all you're really doing is investing based on past winners. Your performance becomes totally dependent on economic conditions like inflation and growth. The smarter approach, the strategic approach, is to actively manage your mix of assets, control your regional exposure, and intentionally add real diversifiers. And that really leaves us with one final powerful thought. A benchmark, by its very definition, is a reflection of the past. It just tells you where the market has been. So the real question you have to ask yourself is, where do you want your portfolio to go?